Um, Good evening. My name is Carol Skillen. I am a CPA/CGA, which is basically the same thing. Sort of private, whatever I am. I'm certified general accountant originally. Anyway, this presentation is a whole lot of odds and sods. As you can see, it is financial information for caregivers, but it does cover a few other things as well. But first of all, whoops, sorry about that. First of all, here we are. I have to give this disclaimer, and I know you can read, but I am required to read this out loud. The purpose of the presentation is to inform and educate the attendees on the presentation topic or topics. While the information contained in this presentation is believed to be accurate, no action should be taken based on the presentation alone. And it is available with the understanding that the publisher, myself, is not engaged in rendering legal, accounting, or other professional services and is not representing any other body or organization. So the information that I'm presenting is current as I can get it to be, up to date, and it's a very high level discussion on these particular topics. So I'm going to look at medical expenses. What are they? Where you claim them on your taxes? Most people use a software program these days, but it still helps to know what you can and cannot claim. Also going to look at the disability tax credit and various other credits that may be available to you outside of medical expenses. Also going to look at the Canada Caregiver amount. So some of you who are caring for elderly parents or a spouse or whatever, there are certain amounts that you may be eligible for, which will reduce your taxes. Managing finances in retirement is another one. It's a very global kind of talk on this part because that is very situational to an individual, and I don't know people's different circumstances, so I can't say specific things for anybody. Also, trusts was something, and a little discussion on power of attorney. Now, these topics were put together because Dean Henderson provided me with a whole list of questions that he got from members of the Dementia Society and asked if I could put something together to answer the questions. And these were the ones that were most popular, these topics. So without further ado, excuse me. Medical expenses. So a medical expense is a non-refundable tax credit. So what that means is it directly reduces the tax payable amount. And forgive me while I jump about. I want to share something else with you if I can find what I'm looking for. So this is the new T1. This is your tax return that you file as an individual. And medical expenses, as I said, are a non-refundable tax credit. And they come down here. They're on this particular page. So as you can see, there is, well, essentially a minimum amount that you must have in order to be able to claim a medical expense. So if you have $2,300 or less of medical expenses, or 3% of your income, whichever is less, is deducted from the amount of expenses that you have. So just know that even though you do have a lot of medical expenses, you may not get the full amount of the expenses that you actually had. Sorry. Okay. So they are identified in the Income Tax Act. Not that anybody's really going to read that one, but they include expenses for you, your spouse, and your children, and then also people who are dependent upon you. Now, a person who's dependent upon you over the age of 18 would include a grandchild, a parent, a grandparent, a brother, sister, uncle, basically the immediate family and one extension. They're dependent on you for support at some time in the year, and they were resident in Canada at some time in the year. So these are medical expenses that you can claim on your tax return. So an eligible medical expense. So there's a whole bunch of different things, and there is a guide put out by Canada Revenue Agency. the number is basically, or sorry, the names are just basically medical expenses. The number is RC4065, and I will provide that a little bit later on in my resources slide. And it lists pretty much everything you can imagine that would relate to medical things, and tells you whether or not it would be a medical expense, an eligible medical expense or not. So I'm going to go through just the main ones, or not the main ones, but the hot ones, I guess. I don't know. So medical services, attendant care, and various items such as that. So first of all, medical or dental service. So eligible medical expenses is a medical or dental service. Okay, so it is paid, an amount paid to practitioner, dentist, nurse, whichever, in respect of the medical or dental services. Okay, so that specifically is what it is for. And so it's to treat conditions, or excuse me, rehabilitative services, therapeutic, things like that. So that's what an eligible medical expense is. Um, and then other things that fall under eligible medical expenses, care, treatment, and training. So if you are receiving care or receiving treatment, you have to pay for it, then it's probably medical expense. And the training, so this is training to learn to care for a person. So if you are taking care, so it's an amount paid for you or a relative to learn to care for a relative who has an impairment in physical or mental functions and is a member of your household or is dependent on you for support. So if you have, a friend of mine, her husband had a stroke. Okay, so he was bedridden. So she went and she took a course to learn how to move him safely so she wouldn't hurt herself. So that is something that she could write off as a medical expense. Construction and renovation. So if you make any changes to the house on account of somebody needs certain things in the house, doorways widen for a wheelchair or something like that, then that potentially could be a legitimate medical expense. Travel expenses. Now everybody thinks, oh, I'm just going to drive over to the doctor's office and I'm going to claim the charges. It doesn't quite work that way. As you notice, as it states here, that it must be 40 kilometers one way. So basically it's not available in your immediate location, whatever the service is that you're required to have. And you only get essentially the mileage if it is like the transportation only. If it is between 40 and 80 kilometers, you get mileage only. Anything over 80 kilometers, then you would get accommodation if you're required to stay over, meals and parking. And if you hire a one of those ambulance services or a patient transfer service to take you from point A to point B, that one would be an eligible medical expense regardless of the distance that you are going between point A and point B, because it's a separate expense paid to a separate third-party company. So attendant care. So this is different than the caregiver amount. Okay, there is a caregiver credit, but this is attendant care and it falls under medical expenses. So attendant care is care given by an attendant who does personal tasks for a person which they cannot do for themselves. It is very important to remember that. A lot of people are asking that. Oh, I take my spouse to a day program where they do something, just I don't know, activities during the day so that, you have a tough time to go off somewhere else. That would not be attendant care. So that would not qualify as a medical expense under that. So it's full-time care or specialized care. And retirement home versus a nursing home. So a retirement home, think of the ones where you live in your own apartment, you're in a retirement home, but you have your own apartment, you have a kitchen, or maybe you go downstairs to the cafeteria for lunch or whatever, dinner, but you're essentially independent in your home. This is not a nursing home. This is not something that would be eligible for the wage or the rental payments that you pay for this. Such a place would not be eligible. However, if you have an attendant come in and take care of you and perform some tasks, then that would be. A nursing home, however, is different, and that is generally, think of, 24/7 care, and you're there because you're unable to care for yourself or something like that. Those are pretty much everything is included in the medical expense. And just be careful if you do have attendant care expenses and you have a disability tax credit. That's what DTC stands for down there. Be careful, because sometimes you can claim the disability tax credit and sometimes you cannot if you're claiming attendant care expenses. So I'm going to run through the various types of attendant care, the type of expenses that you can have. So as I said, fees paid for full-time care in a nursing home. This is that 24/7 thing where you are, or your spouse, loved one, whomever is living because they cannot care for themselves and they require this. So everything, pretty much everything that you pay in that nursing home would be considered a medical expense. The only things that would not be would be something like getting your hair done or something like that. It's like a personal expense, having your laundry done, that kind of idea. But everything else would be included: food, accommodation, nursing care, admin fees, maintenance fees, and sometimes even the social programming and activity fees would be included. Now note, in all the cases, and there's 3 slides indicating the different types of attendant care that are, I won't say available, but are categorized. There's a certification required in order for the individual to be able to claim it. And in this case, if you're in a nursing home, Form T-2201, that is the disability tax credit. So if you have a disability tax credit, good to go. If not, in this case, if you can get a letter from the medical practitioner to certify that you basically need to be in this home. You can't live alone, and people where, like, your spouse cannot care for you. So either the disability tax credit or the letter. Now, can you claim the disability amount? And I'm going to go through an example a little bit later. But medical expenses, as we're going through it right now, so the medical services, all the different little bits and pieces, hearing aids, batteries for hearing aid, things like that, caregiver expenses, they're part of medical expense. The disability tax credit, which, as I said, I'll discuss later, the disability tax credit is a separate credit amount from medical expense. So as I was saying, in some cases, you can claim both medical expense and when it comes to attendant care, just when it comes to attendant care, you can claim both the attendant care expense and the disability tax credit, or one or the other. In this particular instance, if you're in a nursing home and you want to claim that expense, and you have a disability tax credit, you cannot claim both. Now, the disability tax credit, the amount is, I forget exactly right now. It's a little over $8,000, I believe. And quite simply, I don't know any nursing home that costs less than $8,000 a year. So you're probably better off taking the claim of the nursing home expenses. The next one, salaries and wages, full-time attendant care outside of a self-contained domestic establishment. That's CRA talk for saying outside of a residential house. So basically, if you're living in a retirement home or something like that. So if you're in a retirement home and you're in one of those independent living things, but somebody comes in to help you with those personal um, daily activities, those personal tasks, then you may be eligible to claim the caregiver expense. In this case, you must have a disability tax credit in order to be able to claim the expense. And again, it's either disability tax credit or the attendant care expense. You'd have to play with the numbers to see which one works out best for you. Salaries and wages for the attendant caregiver in Canada. So this is where they do not live in. They come to you, personal services workers, things like that. So they come to your house and help you. And in this case, again, certification must be a disability tax credit. Now, this is one where you can claim both the disability tax credit and the attendant care expenses, but there is a limit. So you get the disability tax credit amount and up to $10,000 for the attendant care amounts, or $20,000 if the person happened to pass away that year. So this one you can get in both, but again, it's a numbers game. You have to sort of figure out which benefits you the best. If you paid $30,000 in attendant care, well, obviously $30,000 is greater than 10,000 plus the 8,000 from the disability tax credit. So again, the choice is yours. Full-time attendant care at home. So this would be you're living at the same address. So again, must have the disability tax credit or a note from the doctor saying that you require the care. And this one, again, we go back to claim one or the other, but not both. And sorry, just looking at my note. Let's see. And so salaries and wages for care in a group home. There is, or you must have the disability tax credit. And this one, you can claim both. And there is no limit on the amount paid for the salaries and wages for the caregiver. And then the final one, if you're carer training into care at a school, institution, or other place, then you have to have either the disability tax credit or a note from the doctor. And again, both can be claimed, provided of course, the amounts are eligible. And so that covers the attendant care versus attendant care expenses, which are a part of medical expenses. So that is the end of discussing medical expenses. So again, medical expenses are those medical dental services. So you go to the dentist, you pay, whether you have insurance or not, you get a portion of it back. The portion you don't get back would be an eligible expense. Any insurance, health insurance, group health insurance that you pay would be something. Your drugs, medications, as I said, hearing aids, batteries for hearing aids, walkers. There's a whole list of things that are eligible. And as I said, the guide from CRA RC 4065. If you Google RC 4065, go to the canada.gc.ca website and have a look through. You'll see it's from A to Z. It's got all different kinds of things which are considered to be, or they tell you if it's not, a legitimate, eligible medical expense. I shouldn't say legitimate, but eligible medical expense. Okay. So the disability tax credit. So I've been referring to that. Now this is, as I said, it's a non-refundable tax credit. And I do have this year, actually, I'm looking at 2019 tax return. It's $8,416 is the maximum amount that can be claimed if you have the disability tax credit. So now in order to have a disability tax credit, you must apply for it. And it's a very long form, but only long because there's 5 or 6 different parts, and you only really have to fill out one because you're claiming it because you can't do a certain thing. So basically you are restricted. Sorry, I'm going to go back to how you actually fill it out and do all that. So you have the disability tax credit, and if you bear with me, I will go, and I know this is probably the long way to do things, but it's the only way I know how. Okay, so this is there we go, disability tax credit certificate. And fill it out before you file your taxes. You can't fill it out and send it in with your taxes because it will, one, delay your taxes being reviewed. And if you don't get it, then you'll end up with an assessment. So it is generally suggested that you get the disability tax credit approved before you actually put it on your tax return. So as I said, it's quite lengthy, but the first page is, about the person that you're applying for, or yourself, the case may be. So as you can see, there are different things. So the basic activities of daily living. So you must be restricted in one of the basic activities of daily living, or in a couple, and they are vision. So, vision. So if you're blind, that's it. You're going to get it. Speaking, hearing, walking, eliminating, feeding, dressing, mental functions for necessary for everyday life, and life-sustaining therapy. So these are all the different reasons why you can apply for a disability tax credit. And the one that Dementia Society participants or members would probably most likely interested in would be the mental functions necessary for everyday life. Now note that it must be completed by a medical doctor, nurse practitioner, or psychologist. If it is not, then it will not be reviewed. It will be denied. So you have that. And the most important page on this, once you get the other applicable part filled out, is this page right here. It's called Effects of Impairment. Now the doctor writes down what the impact of this particular disability is on the individual and how it impacts them getting through their daily routines or their everyday life. And if it is not written in a manner that totally indicates that the person cannot do one of these activities of basic activities of daily living, then the application will be denied. So it's very important that this part is filled out correctly. Sorry, I'm going to go back now to this. So that once it is approved, then you will get a letter from CRA, which will indicate the duration of your particular status for the disability tax credit. It can be backdated, so that if somebody I know, their child is diabetic, so diabetes just doesn't happen overnight. Something that has been going on for a while, but you just recently realized that she could apply for the disability tax credit on behalf of her daughter. So what they did was she applied for it last year, but they backdated the disability tax credit to when she was first diagnosed with diabetes, which was probably 2 or 3 years ago. So they'll backdate it. And what they'll do then is, if they backdate the disability tax credit, they will also go back and amend your tax returns for you to take into account that you should have gotten the credit. Now, having said that, again, it's very important to know that you are markedly restricted in one of those daily activities basic activities of daily living. As I said, speaking, hearing, walking, eliminating, feeding, dressing, mental functions necessary for everyday life, life-sustaining therapy, or you're blind. Vision. Because I give the example, my mother, when she was 19, she had polio. So she had lasting effect because of the polio. She cannot use her left arm. However, everybody says, oh, well, you're disabled. Well, I guess technically she is, but she does not qualify for the disability tax credit because she is not restricted in any of her activities. She's able to do everything that she wants to do, other than handstands. But she is a going concern, and she can do everything. So she would not qualify for the disability tax credit. So just be aware. And again, make sure that part that on that second to last page is filled out in a manner that it is very clear that the person is impacted in some way, so that they cannot do one of the basic activities of daily living. So, as noted before, when I was talking about the attendant care expenses, which are part of the medical expenses, when you have the disability tax credit and you have attendant care expenses, medical expenses, you really need to sit down and figure out, well, which is best for me to claim. So have a little example. So John, my friend John, his only income is a $29,000 disability pension. Okay, and he does have an approved disability tax credit certificate. So he's had that for a few years, and he pays his neighbor $14,000 annually for full-time care. So his neighbor comes over and takes care of him, does some basic activities for him. So again, sorry about this. I have to keep popping back and forth. Now I have to find what I'm looking for. Oh, there we are. So if we look at John's taxes, so basically we said that his income was, oh, sorry, I'm looking at his non-refundable tax credits line. So John has a basic personal amount. Everybody gets this. If you're breathing, you're going to get this. At least for 1 second in the year, you will get this. He has a pension income amount. So that I'm calculating his non-refundable tax credits here. So I want to see the impact of claiming the attendant care and the disability tax credit. So that maximum amount of $10,000, or claiming all of the attendant care and not claiming the disability tax credit. So I'm just going to show the comparison here. So in this case, we run through, so basic amount, pension income amount, disability tax credit amount, $84.16, medical expenses. So you've got the $10,000 of the medical expense, and then you have to deduct a certain amount of your net income. So that left him with $91.30 as a medical expense due to that caregiver amount. So we add this all up and we get his total non-refundable tax credits are $31,615 multiplied by the credit rate, which is 15%. Okay, so that means that his actual total federal non-refundable tax credit, sorry, there we go, is $47.42. Now, if we look at his income and his tax rate, his applicable tax rate on the $29,000, we see that his taxes that he would owe are $43.5. So we take off the non-refundable amount and he gets back a credit of $392. So that's if he does the disability tax credit and the caregiver expenses. Sorry to do this to you yet again. And where is option 2? There's option 2. So this one is, you notice, he is not taking the disability amount for himself. He is going to take the full $14,000. He still has to deduct 3% of his income of that $29,000. And he ends up with $27,000 of federal non-refundable. So the total amount multiplied by 15 gives him just over $4,000 of a non-refundable tax credit. So in this instance, he ends up owing $270. So again, it's a numbers game. You just have to sit down and play with the numbers to see which is better. But as I said, just think it's 10,000 plus 8,000 for the disability tax credit. If your caregiver amounts are less than $18,000, then it's to your benefit to claim the 10 and the disability tax credit. If they're more than the $18,000, then obviously you would go the other route. You would take the attendant care expenses. Okay, so these are the resources that I was talking about, or the one at least I was talking about. They're all very good resources, and you can find them on the CRA website. I would suggest, though, that you Google the title or the guide number or something, and then just go to the link, because sometimes it's a little hard to find documents on the CRA website, and it's easier if you sometimes just type that in. But as I said, the RC 4065 medical expenses, it is just a huge laundry list of everything you can think of that you might use as a medical related item, and it will tell you yay or nay whether it is actually something that would be an eligible medical expense. And if you are not aware, the disability tax credit information, the folio that's noted there, S1, F1, C2, is very good information, and it tells you how to go about applying for it, and what the criteria are in order to be able to get your application accepted. Okay, so moving along. There are other credits, other tax credits, whether they're non-refundable tax credits, refundable tax credits, or they're just reductions to your income that you may be eligible for with regard to expenses that are laid out to help somebody who is suffering some sort of impairment. So in addition to renovation expenses, which would fall under the medical expense side, there is also home accessibility expenses for permanent renovations made to, but here the person must be 65 or older, or they're eligible for the disability tax credit, which basically they just get it, make it easier. So in these ones, you can claim the non-refundable tax credit if you own the home in Canada and paid for the renovations, eligible renovations, to improve the safety or accessibility of the home. And you can claim up to $10,000 per year in eligible expenses. So it must be the main residence. So it's got to be where they live, 100% of the time. Well, 99% of the time. Refundable medical expense supplement. So the medical expense that I showed you was a non-refundable tax credit. Now, a non-refundable tax credit, you can have all the non-refundable tax credits you want, but it's not going to make a hill of beans of difference if you don't have taxes payable, because that's where the non-refundable part comes from. So what a non-refundable tax credit does is it takes the tax amount that is calculated on your taxable income, and it reduces that amount. And once you reduce it to zero, it doesn't go any further. So if my taxes owing on my taxable income are, we'll say $1,000, okay, I owe $1,000 in taxes. My non-refundable tax credits end up being $1,500. Well, I'm not going to get back $500. It's gone. It's non-refundable. I'll just bring that $1,000 in taxes I owe down to zero. The refundable medical expense supplement is just that. Even if my tax bill is zero, I can still get up to a maximum of $1,248 as a refund, because it's calculated. It's not a non-refundable tax credit. It's calculated on the last page of the tax return. That would be page 8. So basically it's low income, high medical expenses. So sorry, I do not know what the income level is, and I don't have it handy. No, I don't. Sorry, I was just trying to see if I had the note, but I don't. But it is something that is income based. So obviously the higher your income, the less you're going to get back. A working income tax benefit, again, a low income individual, you may be able to get this. It's a refundable tax credit again, and there is a base amount just for low income and you're working, and there's also a disability supplement to this amount as well. Ooh, there we go. Other credits, continuing along, disability supports deduction. So this one is a deduction from income. It shows up in your calculation of your taxable income. And basically it's for amounts that you've had to pay in relation to an impairment or something or a physical impairment or mental impairment. Expenses you had to pay in order so that you could earn an income or you could attend school. So a buddy of mine, he is blind and he works, but he has one of those reader things. I don't know, I'm not exactly sure how it works, but it kind of reads the computer. So he had to pay for it. So this is something that he would be able to deduct, provided he has all the calculations down. Something like that he would be able to deduct because he requires it in order for him to earn an income. Okay, so something like that. GST/HST credit, everybody can apply for that. That's geared to your income level. And then the amount for eligible dependent. So an eligible dependent is somebody who obviously depends upon you. And there are various conditions. So basically it's you do not have a spouse or common law partner. But if you do, they weren't living with you. You supported the dependent in the year, and you lived with the dependent in a home you maintained. So those are and down below, the dependent parent, grandparent. So if you have a parent that is living with you, they're dependent upon you, then there may be an amount that you can get because you're caring for them. Okay. So those are some of the credits, and those are federal credits, but there's and I don't know provincial tax as well. I know federal tax a lot better, but there are provincial equivalents to most of those credits as well. So the Canada Caregiver amount. So this is not the attendant care expense that was part of medical expenses. This is something else completely different. And there are 5 different places to, excuse me just a minute, I'm going to cough. Sorry about that. I'm not used to talking so much. Okay, so Canada Caregiver amount. I think the easiest way, sorry, I'm going to do this to you again. I'm going to jump back to, if I can find what I'm looking for. So the Canada Caregiver amount, there, as I said, there are 5 different ways to claim it because it depends on who you are claiming on behalf of. Okay, so it's an amount, and I'll go and explain how you calculate the amount and where you calculate it. So it can be included on line 30300, well, this one here, spouse or common law partner amount. So there's a base amount that you get, and it hinges on the income of the net income of your spouse or common law partner. But if you can claim the Canada Caregiver amount, you can add an additional amount into this line because you are caring for them. Same thing here, amount for eligible dependent. You can add, again, it's a calculation based on if they have any income or anything like that. So you can add an amount there. And this one here is another Canada Caregiver amount for spouse, common law, eligible dependent. And you're thinking, oh, well, I just calculated it up here. Well, yes, you did. But up here in these two, the base amount of their income is lower than it is here. So you may not be eligible to claim the Canada Caregiver amount on line 3,300 or 3,400, but because the base amount to calculate it is higher on line 3425, you may be able to claim it there. Excuse me. And then here's the next one, Canada Caregiver amount for other infirm dependents aged 18 or older. And then this is the one for kids under 18. So as you can see, there's 5 different ways to claim the Canada Caregiver amount, depending on who it is you are declaring that you are caring for. So as I said, you can add to the base amount. So for the spouse or common law, you can see that the net income is $12,069, and that's current up to 2019. So that is if their income is less than that amount and you are their caregiver, then you may be able to add up to the 2230 into that line of eligible dependent. Sorry, looking at the wrong line here. There we go. Flipping my papers around. For the spouse or common law partner amount. So you can add the Canada Caregiver amount in there. Then the next one is on, so the spouse or common law partner eligible dependent age 18 or over. So the net income is between 71 and 23. So as you can see, the income is higher. So as I said, if you can't claim it in the first instance, I know it gets very confusing and I'm just using all these line numbers, but basically, if your spouse, common law partner, if their income is less than 23.9, then there may be a potential for you to get the Canada Caregiver amount on either of those two lines that are part of the non-refundable tax credits. And the same thing, infirm dependent, age 18 or older. Again, it's a calculation. The maximum that you can get is 7140, and that is if their income is less than 23,906. So the lower the income, the more you get back. And also, if you were able to claim any amount on another line, you don't get it there. Yes, I know, very confusing. And basically, if you're using a tax program and you input all the information correctly, the program does a very good job of figuring out which line to put it on. But the hinge is, what is the net income of that other person? If it's $12,000, if it's between $12,000 and $23,000, you're not going to get it in one instance, but you may get it on another line. Now, if that wasn't confusing enough. So, that is about it for the Canada Caregiver amount. So you have medical expenses, disability tax credit, Canada Caregiver credit. So the medical expenses, you can claim for you and your spouse and your eligible dependents on your taxes, or you can split between the two. The disability tax credit is initially claimed on the individual who has the disability tax credit certificate, but it is transferable to the partner. And then the Canada Caregiver amount is claimed by the person who is the caregiver. So it is not claimed by the person receiving the care, but by the caregiver. Okay, so moving off from all these tax-related issues, sorry, managing finances in retirement. So this is a question a lot of people want to know. And again, there's absolutely no way that I can give you the golden answer, because there isn't one. It is unique to every situation that is out there. But the question, like, I don't know how many questions were there like that. How do I manage living in my own home and my partner has to be in a long-term care? Not an easy task. So basically, because you're stretching your retirement resources to an extent that you probably did not think that you would have to when you started planning for retirement. So one thing with regard to accessing your funds, well, there we go. Generating inflows, so inflows of cash. Whether you have a pension or you're a self-managed pensioner, meaning that you've done your own investments because you didn't have a company pension or something like that, you are going to have to manage them carefully. If you can do it yourself, great for you. Go for it. If not, then you may have to find a financial advisor to help you with investing in order to be able to pay for both long-term care and your own residence where you are living. So these are just examples of things, selling assets, real estate if you have it. Annuities. An annuity basically is you give a whole whack of cash to a trust company, insurance company, and they invest it. And what happens then is, so let's say I gave money and saying, okay, I want to have a guaranteed income of $1,000 a month starting from the day that I turn 65 until the day I die. So at my age, I would have to give them a big whack of cash because I'm not quite 65 yet. So I give them a big whack of cash. They would invest it at today's current interest rates, which are not very good, and to give me that guaranteed $1,000 a month for life. And they determine how much I have to give them based on, I can't think of the actuarial tables, how long I'm expected to live. So if they determine based on, my genetics, my whatever, my family history, health, and all that, that I'll live from till the age of 85, then they have to plan for 20 years of payments to me at $1,000 a month. So that, as you can probably imagine, the future value of all that is going to be an awful lot of money that I have to give them right now. So sometimes it works and sometimes it doesn't. The way to win the annuity game is to live longer than they expected you to, because if you happen to pass away before the 85, um, you don't get the interest back. You probably just get back your initial investment. But anyway, so that's what an annuity is. It's you pay money up front to get a guaranteed income down the road. So it's so those are accessing funds, working later, going back to work, whatever. Um, yeah, it's impossible. But one thing you can do to try to keep money in your pocket is minimize your taxes. So when you are investing, you have to think about, do I have a pension? Does my spouse have a pension? So if I have a pension, my spouse doesn't, well, maybe in order to minimize taxes down the road, so I get more money back, I buy the spousal RRSP so that they don't have the pension. And when they take it out, they're going to pay lower taxes on it. So that's one thing that you can do. Um, when you do have your RSPs, so you've invested in RSPs, and we also have the tax-free savings account thing. So balance what you're investing. So put some in the RSP, put some in the TFSA, because when you go to take it out, so you take it out of the RSP or it rolls into a RIF and you're required to take it out, you're going to pay tax on it when it comes out. Whereas tax-free savings account, hence the name, there are no taxes on the money that you withdraw from the tax-free savings account. So you can play with what your taxable income would be in over the course of the year by taking out lesser of the taxable part, the RIF, the RRSP, and more of the TFSA, or whatever the balance works for you. Pension splitting and CPP sharing. So pension splitting is you can split up to 50% of your registered pension that you receive if you're receiving one. And that definitely helps. It reduces your tax bill. And if your partner does not have a pension or has a lesser income, it'll bring theirs up. They also get part of the tax that you paid too as a credit on their return. So it's not like you get this big wonkin' refund. No, you give them part of your pension and you also give them part of that tax paid credit thing. So, um, and then CPP sharing. So pension splitting is up to 50%, your choice. You do it every year. You fill it out in your taxes, little form you fill out, and you can change. It can be 1% this year, 50% next year, 25% the year after. It all depends on how it works best for you. CPP sharing is something a little different. When you apply for CPP, and you can apply at age 60 if you wish, when you apply for CPP, you can state that you want to share your CPP with your spouse, common law partner, up to 50%, so that you get half of what your regular CPP would be, and they get the other half. Again, you're doing this because perhaps your partner, your spouse, does not have pension or has lower income, and you want to drive your taxes down. So you give them the CPP, your half of your CPP, so they pay taxes on it. Make sure you're taking advantage of all the federal and provincial tax credits that are out there. We just discussed some earlier. Estate planning, that's just, I just threw that in there because think about what you want to do with your money, because if you don't have a will, quite simply somebody else is going to figure out what to do with your money, and it may not be what you wanted. One other thing that's not on there, that if your spouse, partner, common law partner is in a nursing home, because they need the care and you are still in your own home, there is a form that you can fill out. It's called the involuntary separation, and basically it doesn't change the taxes that you pay in the sense, but what it does is it gives an independent calculation for the guaranteed income supplement and allowance payments. So because the calculation of the amount that you're going to receive hinges on the family income, shall we say, if you have an involuntary separation, then the calculation is based solely on your own or their own income. So you may get a bit more than than otherwise you would have. Excuse me, sorry. Another thing that was asked, some other questions, is would it be advantageous to put things into a trust? Well, yes and no. It kind of depends. Again, everybody's situation is unique and individual. So, first of all, a trust. A trust is three people: person, the settler, who places money or gives money, property, not money, sorry, could be money too, gives property to a trustee who manages that property on behalf of the beneficiary. So you have the settler, the trustee, and the beneficiary. Trust is not a legal entity, so it can't enter into contracts or incur liabilities. So the trustee just manages it, and it pays whatever expenses out of the trust monies that are held there. And it can be either a testamentary trust, so it's created through a will. For example, grandma passed away and wanted to leave money to the grandchildren, but they're all young. So she said, well, I'm going to want to leave $20,000 to each of my grandchildren, but they cannot access it till they're 21. So such monies would be put into a trust. And an inter vivos trust is something that is set up while you are alive for various reasons. And there are 31 different types of them. So the trust. So even though it's not a legal entity, it still pays taxes, and it pays taxes at the highest rate. So if you do put money into a trust, what a lot of people do, excuse me, is the money sits in the trust and it's not theirs anymore. It belongs to the trust, belongs to the beneficiary. But the income that the trust produces is divvied out to the beneficiaries so that it's taxed at their personal rate and not at the rate for the trust, which is in Ontario, the highest individual rate is 53.53%. That's a lot of taxes. So one thing about a trust, it must be established while you're legally competent, but it also makes it a lot easier to manage the assets, for someone else to manage the assets. Now, as the last thing there, it's on the bottom there, consider power of attorney for financial matters. A trust is, there is an expense to setting it up. And then you've got to file the tax returns and all that sort of stuff. Whereas a power of attorney, which I will discuss a little bit after I finish talking about trusts, can give the same sort of comfort. So a trust can be set up. You have to be, as it states here, you must be legally competent, but it can be set up so that if something goes south in your life, then the property that has been put into the trust is protected. It belongs to the trust. It doesn't belong to you, and somebody else is managing it for you when you cannot. So that's that part. So two types of trusts that may be a thought, excuse me, is an alter ego trust. So basically, it's you. It's your evil twin, your good twin, whatever. So the alter ego trust, it is the person. So the settler, and these are the criteria. The settler is the beneficiary, essentially. You must be 65 or over or older. And normally when you put monies or property into a trust, you are deemed to have sold it yourself, and then you have to account for any taxes that may be applicable, capital gains, for example. However, if you put money into an alter ego trust, then you don't have to do that, because it's, even though you no longer own technically the property, you've just passed it to yourself, essentially. So it is not looked at as an outright sale of the property. This is just for the alter ego trust, and the next one I'll talk about. So, and being the beneficiary, you are the one that receives the income during your lifetime. You receive all the income of the trust. Should it distribute it out, you would receive it and you account for it on your own taxes, but leaving the property in the trust. Some people look at the trust as being kind of like a will, because when the trust deed is created, so trust deed is just the forming documents of the trust, you state what you want to happen to the properties that have been put into the trust. So let's say you had a cottage or something. I'm just making this up. Sorry. You have a cottage. You put the cottage into a trust because you rent it out. So it's got income and all that sort of stuff, whatever the case may be. So there's going to be a capital gain on it and all that sort of thing. So you put this property or shares or something, you put this property into the trust. Now I forget where I was going. Oh, so you can stay in the trust that upon the death of the beneficiary, me, I put the cottage in there. Then this is how I want the property distributed. So you put that within the the trust deed. So it is kind of like a will, if you will. There you go. It's a will substitute. It doesn't mean that you don't need a will for everything else, because that's not part of the trust. You still need that other will, but it takes care of what happens to the property that's in the trust. So the advantages, probate is not required because it is not your property. You have given it to the trust, and then the beneficiaries that are named. So when you say what you want to happen to the property in the trust, excuse me, when you pass away, the beneficiaries receive, whatever the property was without any delay, because it doesn't have to go through any processes or anything like that. And also, some incapacitous and incapacity planning can be achieved because you name somebody else to be the trustee. They manage it for you, and if things go south, you're just gaining the income from the trust, but you don't have to manage it. And the other, disadvantage. So again, the tax returns must be filed, and it is the highest marginal tax rate. And there are costs. And then the new reporting requirements, it's nothing really onerous. You just have to list what is the property within the trust itself. And then the other one that may be advantageous is the joint spousal or common law trust. And basically it's the same thing as the alter ego, except it's both parties are entitled to both parties are the beneficiaries and thus entitled to any incomes that come out of it. And if one person passes away, then it still continues on in the name of the other person who is still there. So comparing that to a power of attorney. So a power of attorney is very, very, very powerful. Be very, very careful who you get to be your power of attorney, because basically they are you. Excuse me. So it's used only, so there are two types. First of all, there are two types. General power of attorney is used only while you are mentally capable of managing your own affairs. So that's one. And it's the enduring or continuing power of attorney. This is the one that gives you the ability to do the future planning should something in your life go south. Then that is what the difference between the two. So it's important to know the difference to make sure that you get the right one if that's what you're looking for. So again, it's very, very powerful. So the power of attorney is, they can do anything, okay, unless it's limited. Sometimes people, like if I owned property in a different province and I wanted somebody to take care of it for me, I want to sell it, I might give them power of attorney to deal with that particular piece of property only. So it's limited to that property. They cannot touch any other of whatever meager assets that I might have. And a power of attorney takes effect immediately. So as soon as it's signed, it'll take effect unless you state that it only takes effect should you be declared incompetent, incapable, whatever word is used these days. So you can make the start date. It's up to you when the start date is. The power of attorney cannot do anything with regard to your will or any of your life insurance or give the power of attorney to anybody else. So again, be very careful about who you pick as being your power of attorney. And power of attorney for financial is very different than the substitute decision maker, the power of attorney for healthcare. Somebody asked, can I have the same person for both? Sure, you trust that person. That's entirely up to you. There's no rule about who has to be the power of attorney for you. It's totally your choice and your decision. So that is enough of me talking. So I have no other little tidbits to share with you. So if there are any questions,